In this lesson, we're going to complete our multi-step scenario here with Apple and buying their iPhone factories, financing it with debt, owning it for a couple years, and then having all the equipment break down, having to record a write-down, and then having to repay the loan as well. So just to recap, in the first video in this series, what we assumed is that our property and equipment here went up by 100 because we spent 100 on additional capex. That was at the very instant that we actually purchased the factory. So that went up by 100. And then to balance that, the long-term debt also went up by 100. So that was step one in this series, actually buying the factories with debt. In step two, what we assumed is that there was a $10 worth of depreciation charge right here. And then we assumed also that we had 10 worth of interest expense. And we went through the three statements to see how that was actually reflected everywhere here. And so basically what happened is that our cash balance went down by 2, property and equipment was down by 10, and so our assets were down by 12, and then to balance that on the other side, retained earnings were down by 12 because net income fell, and so our liabilities and shareholders' equity were also down by 12, and so both sides of the balance sheet balanced. So that was what happened after 1 year of ownership. So what we want to do in this scenario is do two things. We want to go out 2 years and figure out how our depreciation and interest income or expense will change after 2 years, and then also we want to assume that we have a write-down. So we're going to assume that we write down the entire value of the factories that are left after 2 years, and then that we have to repay the loan also after 2 years. So for a question like this, once again, you have to confirm the basic assumptions. So you have to figure out what the tax rate is, the interest rate on the debt, what the depreciation charge over 2 years is going to be, and then whether or not any of the debt here is going to be repaid. In our example here, we're going to assume that, as with the first or second video in the series, that none of the debt is repaid, so all we have is interest expense and then a depreciation expense. You also want to confirm the value of the write-down of the PP&E, so you want to just confirm that the entire original balance is being written down, or whether it's some other number, or it's a partial write-down, or whatever else is going on there. And then you also want to confirm, of course, that the entire loan here is being repaid. So if you've confirmed all those things, I think probably the easiest way to tackle this question is to actually trace what happens over the course of 2 years first, and then to go into what happens when you actually write down the value of the PP&E after those 2 years, and then when you repay the loan after those 2 years here. So I'm going to enter in all the changes here, and then I'm going to go through the order in which I recommend that you tackle this type of question. So after 2 years, if we're assuming straight line depreciation, we're going to have a depreciation expense of 20. So that's after 2 years. Again, you want to confirm this with the interviewer. For the interest income or interest expense here, it's after 2 years. So we have a 10% debt interest rate per year. What we're going to do here is just multiply this by 2 because we have this 100 original balance. It's after 2 years now. So we have a debt interest expense of 20 here. Now, in addition to all those, we're also going to assume that we have a PP&E write-down here, and that this debt now has to be repaid. So if you think about it, for the PP&E write-down here, let's just think through mentally what happens. So after 2 years, you have a depreciation of 20, which means that of your original 100 balance here, you only have 80 left, and you're assuming this entire balance of 80 is being written down here. So let's go in and enter PP&E write-down changes by 80 right here. And then also after 2 years, you have to repay all this debt, because if everything is written down, the company may be on the brink of bankruptcy or something like that, then you have to repay this entire debt balance after those 2 years. It comes due early. So in this case, we've assumed no principal repayment. So in this case, the entire original balance is going to have to be repaid. So I'm going to enter negative 100 here. Negative 100 indicates that we're repaying debt. A positive number here would indicate that we're actually raising debt. So this is the basic setup for our scenario. So with all these in place, now let's go over to the income statement and see what happens. So on the income statement here, depreciation is up by 20. So our operating income falls by 20. Interest expense is up by 20. And then we also have a PP&E write-down here of 80. A PP&E write-down will show up as a net loss on the income statement and will hit pre-tax income, similar to the interest expense. So overall, our pre-tax income here will be down by 120 because we have 20 coming from the depreciation expense over 2 years. We have 20 coming from the interest expense, and we have 80 coming from the PP&E write-down. So overall, our pre-tax income here is going to fall by 120. If you assume a 40% tax rate here, then our net income is going to fall by 72. I realize the math here is not very clean to figure out what 40% of 120 is. So in an interview, you may get better numbers than this, you may not. To be honest, with this type of scenario, it's hard to come up with very clean numbers. So just be prepared for having to do this type of mental math to figure out what 40% of 120 is, for example. So net income here is down by 72. So what we want to do next is go over to the cash flow statement. Here, net income is down by 72. We know because we just calculated that. Depreciation is up by 20 here. This is what has accrued over the course of 2 years. We have a PP&E write-down of 80. We're adding this back because it's a non-cash expense. So overall, our cash flow from operations here, if you think about what's going on, so our net income here is down by 72, but then we're adding back 20, so it's up by 20 because of the depreciation. So 72 minus 20 is 52, and then we're also adding back this PP&E write-down. So 52 minus the 80 here gives us a change of positive 28 for cash flow from operations in this case. No changes on capital expenditures or investing activities because we've already recorded these. And then on financing activities, we're repaying this long-term debt, so our cash flow from financing here is down by 100. So overall, when all is said and done here, cash flow from operations is up by 28, and cash flow from financing is down by 100. So this means that in this case, our increase or decrease in cash is going to be a decrease of 72 in cash in this case. So our cash is down by 72 because cash flow from operations was up by 28, but then cash flow from financing here was down by 100. Moving on to the balance sheet. So cash here is down by 72. PP&E is down by 100 because we have the 20 worth of depreciation as well as the 80 worth of PP&E here. And so what happens is that our total assets falls by 72 plus 100. So basically it falls by 172 here. On the liabilities and shareholders' equity side, our long-term debt is down by 100. So liabilities is down by 100. And then retained earnings here is down by 72 because as we saw before, our net income here is falling by 72. So the liabilities and shareholders' equity side on the balance sheet is down by 172. Our asset side was also down by 72. So both sides of the balance sheet here balance, and our scenario here is complete. Now I realize the numbers here were not especially great, and this was definitely a more complex question than everything else we've looked at so far, but this is just to further prepare you, and because you may encounter sort of messy numbers like this in an actual interview. So it's good to get acquainted with it and with some of the requirements here. This is certainly a more advanced question, and it's not something that I would expect in every single entry-level investment banking interview. If you have more advanced knowledge of accounting or finance, you could certainly get something like this, which is why I wanted to cover it in this set of videos. Again, the most important points to keep in mind here are to really figure out what the assumptions in the beginning are. So figure out how depreciation is changing, what the yearly changes, figure out what the write-down is after those 2 years, figuring out how the long-term debt really changes and how the interest income or expense is affected. You have to figure out what all those assumptions are in the beginning. And then what I would recommend you do is rather than starting after 1 year, I actually recommend you start from after the initial purchase and an initial debt raise here, and then you go through what happens over the course of 2 years on the income statement. Because it's going to be a lot easier for you to track what happens over the course of those 2 years with 2 years of depreciation and interest expense, and then the PP&E write-down, and then the debt repayment, versus you having to start from year one, because the numbers are just harder to track. You have more to keep track of in that case. So I recommend starting in this case from the instant after the debt was issued and the factories were purchased, and then going through what happens in year one, and then going through what happens in year two. And that's the recommended order for tackling this type of question. If you go through it logically and go through the income statement, start there, then go to the cash flow statement, and then go to the balance sheet, it should not be too difficult. The main challenge, I think, in this type of question is just keeping track of all the numbers and juggling them in your head. If you get something even more complex, you should certainly do that, but I think for this type of question, it is probably acceptable in an interview to ask if you can write down some of the numbers, not even for math purposes, just to remember them and make sure that you're keeping everything straight in your head for this type of question. But that's how you would walk through the changes here and how you'd actually model out what happens when you buy a factory with debt, you own it for 2 years, you pay interest and depreciation expense, and then after those 2 years, the factory breaks down, you have a PP&E write down, and you have to repay the loan at the end of the period.